Good afternoon, everyone. Thank you for joining us for today's great training on navigating bank statement loans for loan officers. Bank statement loans are the most common non QM loan type, right? They really gained prominence when the interest rates started spiking in February of 2022. Uh, they were around 3%, 3.5% at that point, and basically have a little bit more than doubled. And that um, altered the affordability for many borrowers um, on their loan, right? They were previously pre-approved at a 3.5% rate, but now it's 7%. You got a higher payment, you're going to have a lower uh, payment amount that they're going to qualify for, or a lower loan amount that they're going to qualify for, should I say, because the payment amount is higher due to the higher rate. So those borrowers that are self-employed have been able to pivot, and if they want to be pre-approved for the higher loan amount based on bank statement income rather than tax return verified income, big benefit there. So I believe the last time I checked, bank statement loans were probably over 60% of the non QM loan origination. So let's get right into it. Navigating bank statement loans for loan officers. So, what exactly is a bank statement loan? Well, a bank statement loan is a non QM loan which uses the borrower's business, personal, or commingled statements to qualify to calculate, the monthly income and qualify the borrower. So, what do we mean by commingled statements? Commingled statements means that you're using both personal and business bank statements to qualify the borrower. Now, we can have a look back period of either 12 months or 24 months. Now, usually we prefer the 12-month look back period because there's less of a probability of trends, unfavorable trends, or issues, right? You could have declining bank deposits or other situations going on that if you stretch it out over 24 months, then it becomes obvious, right? If maybe in the previous 12 months, they had a stellar year, 2023, but 2024 was not as good, and you're using 24-month look back period, you're going to have declining bank trends, declining bank deposit trends if you use 2024 and 2023, and then you may have a situation where your loan gets denied. So always do look at that. The only benefit really to going with the uh, 24 months is that in some cases you're going to have a little bit better pricing, usually not more than a quarter point better for the extra months look back period. Now, please do note bank statement loans are for self employed borrowers only. And one very interesting note is that with a bank statement loan, you can combine additional income types. This means that you could have a borrower that has bank statement income. That borrower could also have W 2 income as long as it's from a different business, right? Not the same business that is the bank statement deposit business. You could have profit and loss income also from a separate business. You could have asset utilization from accounts with large balances, stocks, bonds, mutual funds, checking, savings, and you could even have 1099 income. Again, do note that the 1099 income, the profit and loss income, the W-2 income, and the bank statement income, if you do have all four income streams in that loan, would have to each be coming from a different entity. Right. So if this person has you know, three businesses or two businesses and is self-employed or receiving 1099s from another company and gets W-2 income from another company, they could essentially have four income streams. And then with the asset utilization, you could essentially have five income streams for one loan for one borrower. So that is a pretty cool feature there as well. So let's talk a little bit about eligible borrowers and transactions. Now, uh, self-employed borrowers with minimum 2 years in business, right? That's the standard. However, do note that they can be 1 year in business if they were previously performed the same job duties as a W 2 employee. Now, what are some common examples of this? For example, you have an electrician. They were a licensed electrician working for a company as a W 2 employee. Now they are a licensed electrician out on their own, right? So if you got the 12 months in the current business and you have at least 12 months doing that duty as a W 2 employee, then we do have options for that. A doctor and nurse are also common examples of the scenarios. Uh, Usually a lot easier to make this connection when the job that they previously held required some type of license or certification. Not necessarily absolutely required, but definitely makes it a lot easier to make that connection. As far as immigration statuses, bank statement loans we have for U.S. citizens, U.S. permanent resident aliens, non permanent resident aliens with work authorization, and an I-10 borrower. An I-10 borrower is a borrower that has an I-10 document which allows them to file taxes in the U.S. An I-10 borrower lives full time in the U.S., is going to have U.S. based credit, but does not have a work authorization document and does not have legal permanent status in the U.S., but they are living here and working here. That is an I-10 borrower. Our maximum LTV for our bank statement loans, being a non-QM product, is 90%. On the cash out, you're looking at 85%. Now, 90% maximum is for a purchase, 85% max for a cash out refi, 85% max for a rate and term refi. Delayed financing max 90%, and second mortgage options max 85%. Now, delayed financing, for those of you that may not be aware, excuse me, delayed financing is a transaction where the borrower purchases the the property with cash. There is no financing of any type on that property. Now, it could have been a line of credit from another property that they have, but then they got and paid cash for the property, quote unquote. So that transaction um, is basically 6 months out, maximum of 6 months. The borrower can do delayed financing. After 6 months have passed, they can no longer do delayed financing. In a delayed financing, they're going to treat it like a purchase, and they're going to allow the appraised value to be the market value. No need for seasoning. That's the main key for the delayed financing. No need for seasoning to use the appraised value. However, the maximum amount of the loan cannot exceed what they paid for the property and plus the closing costs. So whatever were closing costs plus financing costs is the maximum loan amount for a delayed financing transaction. So let's talk about program options. Now, I do always like to stress that, as is the case with all non QM loans, all program options will have guideline variations specific to that option. What that means is that you're going to have a difference in the guidelines, usually, almost always, from guideline to guideline, right? From guideline to guideline, it's going to deviate. So do not make any across the board generalizations on your bank statement loans. What you need to do is once you identify the option that you think best fits that borrower, then review the guidelines and make sure that the loan will work for the parameters required by the borrower. Now, first option is the option using business bank statements. Uh, do note that most of these options start with a 50% expense factor. Now, you can decrease the expense factor with a CPA letter stating what the business's expense factor is. Now, notice that I have um, the quotes there around CPA because it doesn't really have to be a certified public accountant. That's just the terminology that is common in the industry when we want a letter from an accountant or a CPA or a tax preparer. They just put CPA. But that letter could come from, like I mentioned, tax preparer, accountant, or CPA, and it just has to state some basic information, and included in that basic information, it has to state the expense factor for the business, right? Could be 20%, could be 30, could be 40. Now, some program options, if you look at the table that I have there that says fixed expense ratio, this is important, and you may not find out about this until you review guidelines, right? Some program options have expense factor tables based on the business type and on the overhead expectations. So if you look at the table, you'll notice, for example, the first option says for FTE stands for full-time employees, number of full-time employees or contractors. The first one says zero. So that's going to be for a one-man shop, right? Person doesn't have any employees, doesn't have any independent contractors, not paying out any salaries, not paying out any commissions. Everything is to them. So in this particular option where I took this table from, if it's a service business, then the expense factor is 20%. That means you're going to be able to use 80% of the deposits. If it's a product based business, in this same example, zero full time employees and contractors, but they sell a product, they're not offering a service, then the expense factor is a little higher. You're looking at 40% expense factor. And then notice as you move to the right, now you got 1 to 5 employees or contractors. Expense factor is 40 for the service, 60 for the product. And then notice if you have 5 or more employees, 60% expense factor service, 80% expense factor for a business. So it does really change the loan when you have these tables. So it can help you get that 80% deposit amount if it's 0 employees in a service, but it can definitely hurt you if you have 5 employees and you're a product business. So look at the guidelines and see if they have a fixed expense ratio table or if they go with the default 50% and have the option of the borrower to provide a letter from their CPA. The second option is personal bank statements. Now, most people opt or think that the personal bank statement is the option that they're going to go with because the personal bank statement option allows considering 100% of the business deposits into the personal bank statement. However, there's a big caveat there. It is that if you're going to use personal bank statements and to obtain 100% of the deposit, the borrower needs to provide business bank statements according to those guidelines, and maybe 2 months, and maybe 3 months, to document that the expenses of the business are covered by the business, right? You need to have business bank statements because that's how they're going to gauge what's being paid out by the business. If there are not business bank statements, you can still use the personal bank statements, but you will need to add an expense factor to the calculations, the same as you would for business bank statements. Whatever the expense factor that is applicable for that business, if it's 50% according to the guidelines, or if it's 20% according to a table, that's what has to be applied if you're using personal bank statements where no business bank statements are provided. So that is a key detail there when using personal bank statements. In some cases, some guidelines do not allow using personal bank statements only. Some may require using, if you don't have business bank statements, can't do it. So you just have to review the guidelines to confirm. And then the third option is the combination business and personal, or as we like to call it, commingled bank statements, where some months you're providing have personal, some months you're providing have from the business, because depending on how they deposited the monies, maybe Zelle deposits only go into the personal bank account, can't go into the business bank account, stuff like that. So when you do have commingled bank statements, first of all, confirm that the guidelines that you're using allow commingled bank statements. It's not all of them do. I had one the other day that didn't, right? And the LO had assumed that they did. And when we met for the structure meeting prior to disclosing, we were able to adjust it. But the other point to consider, other than to make sure that commingled bank statements are allowed by the guidelines of the option you've chosen, is to note that when you do have these commingled bank statements, the expense factor, the same expense factor that's applied to the business bank statements needs to be applied to the personal bank statements, right? So that's another key component there. So let's talk about the potential issues and what the solution is, right? So potential issue number one, the borrower cannot document the needed business history, right? This could be because the borrower is not an LLC or an entity of any type, so they don't have an operating agreement nor articles to provide showing the creation date of the entity. The borrower also self files their tax returns, so they do not have a CPA or an accountant or a tax preparer to provide the third party verification letter. The borrower is in a type of business that does not have a business license. So in these cases, it's going to be a little difficult to document self-employment for this borrower. Now, this is going to be an issue not just for a bank statement loan. This would be an issue for a profit and loss loan as well, because obviously they don't have a CPA. They don't have a CPA for the P&L. They're not going to have a CPA for the third-party verification letter either. So that's a difficult one to get. I mean, we've been able to work around it. Sometimes, depending, I had one where the person owned a convenience store. I think it was a 7-Eleven. So we were actually able to accept a letter from 7-Eleven documenting their ownership in the business, how long they've owned it, and all that kind of stuff, because he did not have, any of the documents that would show what we needed, but the letter from 7-Eleven worked. So now issues more in tune with the actual bank statement loan type, declining deposit trends. You already heard me talk about this one earlier when we were talking about issues that can arise with uh, extending the look back period to 24 months from 12 months, the declining deposit trends. Like with any other self employment, if you have declining income, that is a big red flag. And in most cases, if the income is more than 20%, which is the threshold, that's a big red flag. Could cause the loan possibly to be denied unless some good documentation is provided. So declining deposit trends, number two, big issue. Number three, large deposits that cannot be documented. Now, here we're talking about deposits for income, even though it could be deposits for assets if it's a purchase. But in this scenario, we're talking about deposits for income. Please note that most of the guidelines are going to require all deposits greater than 50% of the monthly income to be documented. Right. So again, you got to review the guidelines to see if it's applicable. But if it is, then and if you have large deposits that the borrower says no, there's nothing that I can provide for that. I can't provide a contract. I can't provide an invoice. I can't provide a copy of the item that I deposited, or they provide a copy of the item, the check, but there's no real tie-in to a business operation, then that deposit may be excluded from your calculations, and then it could affect your monthly income. So do be aware of any deposits 50% or greater than the monthly income that has been calculated would all need to be deposited. I mean, documented, excuse me, sourced, in most cases, seasoned. Issue number four, irregular deposit trends. If you got, let's say, deposits in January, then you don't have deposits for another 2 or 3 months, and all of a sudden you got a couple deposits, then again for another couple of months, nothing. These irregular deposit trends could be an issue. Now, that's where explanation and documentation will need to be provided regarding the business type, the business cycle. How often, how long does it take for the business to receive payment once their services are provided? So if it's something usual and customary, for it to be 2 months from the time you sell a product to get paid, and you sold them at one point, and then you're getting paid 2 3 months, and that happens cyclically, and you can show that pattern as a usual pattern for the business operation, then that may not be an issue. But again, it all depends on the regularity of the deposit and the type of business that we're talking about. So irregular deposit trends, another issue. Item number five, NSFs and overdrafts. Big time issue. That's another reason definitely why we may have an issue with stretching it out 24 months instead of 12. Usually, for most guidelines, more than 3 NSFs or overdrafts in 12 months is not acceptable. However, you cannot, again, generalize across the board for all options here, as we do have an option that does not consider NSFs and overdrafts to automatically disqualify the loan. It depends, I guess, how egregious they are. But if there's a plausible explanation there, it's probably going to work out. But again, do note you got to review the guidelines. It's so we do have an option that will accept NSFs and overdrafts. Potential issue number six. This is one where once the underwriter reviews the business narrative and all the other specifics and reviews the bank statements as well, the underwriter may increase the expense ratio, again, due to the business type or due to the review of the bank statements. They may not agree with whatever they may not agree with the table at 20%. They may not agree with the accountant at, let's say, 30%. They may end up hitting you with a customized expense ratio because the business is just paying everything out in expenses in the bank statements. So just be aware that an underwriter does have the option to change the expense ratio due to business type. For for issues number 2, 3, 4, 5, and 6, the solution definitely will be a profit and loss loan. As in a profit and loss loan, you do not have to worry about irregular deposits, high expenses, and other issues that may appear on the bank statements. Um, Now, do be aware there are two types of profit and loss loans. There's the profit and loss loan that is going to require the borrower providing bank statements. Usually it's 2 or 3 months, the most recent 2 or 3 months of bank statements to reconcile to the profit and loss. And you got to be within a certain range of the profit and loss income with the bank statements. And that again depends on the guidelines. Some say you got to be within 75%, others say you got to be within 90% of the P&L income in the bank statements. So that's one option of a profit and loss loan. And the other option we have is a profit and loss loan that does not require any bank statements. So obviously this one is especially good because if the last 2 or 3 months income don't necessarily match the income on the P&L, or if there were NSFs or overdrafts in the last 2 or 3 months, that would um, have an issue with calculating the income because now they may see declining income trends. So definitely, profit and loss loan is the workaround option for when the bank statement loan will not work due to the different problems we mentioned there. So, how do we calculate the income? This is very important. Notice bullet point, first bullet point there, which I have in bold. Always use the investor bank statement service when possible, when available. Most investors and lenders now have scenarios desk for bank statements where you go and you submit or upload your 12 months bank statements or 24, whichever you're using. You upload a business narrative, right? You upload a business narrative, and then they calculate the income for you, return it to you, and in most cases, that is a binding calculation, right? Underwriting will um, use that calculation unless something odd comes up at the last minute. So that's going to be your best bet. And in many cases now, they're making it a requirement. They're making it a requirement in most bank statement loans to submit the bank statements and the business narrative for review prior to submitting the loan, right? They're pre approving your income, which is awesome, right? Last thing you want is to submit a loan with false expectations. You're thinking $18,000 a month in income and it comes back at $5,750. And you're like, what happened here? And then you start seeing all the items that they deducted that they did not consider business related or documentable. As always, you always want to double check their calculations, though. Make sure that everything is good there. And you always want to confirm with the investor or the lender regarding the income guarantee when using the service. Make sure that whatever income you get there is going to be fully accepted by the underwriter, because if that's the case, then you definitely know what your income is, and you can reassure the borrower of the income that's being used and the loan to value. You always want to use, if there is not an investor bank statement service, you always want to use the Excel spreadsheet required by the investor for the option chosen, right? Most investors are going to have, and lenders are going to have their own specific bank statement income calculators where you input the deposits, input the items that are not acceptable deposits, and get your net deposits, and that does the calculations for you, the 12-month average, the 24-month average, the 50% expense ratio, the 30% expense ratio, whatever it may be. You can set up the Excel spreadsheet to make those adjustments and give you your net income. When you are inputting the total deposits, right, you got to remember you're going to usually, and I'll show you the sheet in the next page, but you're going to input the total of the deposits. And then in most cases, you're going to back out each individual non business income deposits. Um, Non business income deposits would be items such as transfers from other accounts that are not business income. You're just transferring money from another account. Credits, like for the return of an item, unverifiable large deposits, and obviously also business loans, right? And business loans deposited into the account are not considered income. Be aware of expense factor ratio restrictions in the guidelines for the option chosen. So I mentioned to you, some have a table that you use, and some have strictly 50% as the default. So make sure you know who you're using and what their guidelines are. And last but not least, make sure to compensate for the borrower's proportionate share of business ownership. So, what do I mean by that? Okay, you got your borrower, let's say he's 50-50 owner with their business partner. The borrower is the only one that's on the loan. So, and we have a 50% default expense factor. We're not using any accounted letter. So in this scenario, assuming that our total deposits are $100,000, the first calculation you're going to do is multiply the 100,000 times a 50% expense factor. That's going to give you $50,000. And then you're going to multiply that 50,000 times their 50% ownership in the business. So now you have $25,000 as the annual income, right? So now divide that by 12, and that gives you your monthly income of 2,000 and change. So always remembering to compensate for the proportionate share of the business ownership. Now, in this last slide, this is an example of one of the bank statement income calculating worksheets from one of our investors. So you're looking at here monthly income. It gives you three options, right? Third party profit and loss validation, or the 50% default expense ratio, or the custom CPA expense ratio, which in this case we had it set at 35%, right? So after inputting the date of the statement and from most recent to oldest, and then inputting the total deposits each month, and then backing out in red, the transactions in red are backing out the unacceptable deposits like transfers, credits, and other things that are not business related deposits. The system gave us a total deposits of 175,031.08. And if you go to the CPA expense factor, if that's what you're using, and you get the letter, and the letter says that the expense ratio is 35%, then our 12-month average income is 9,480.85. However, if we're using the default 50% expense factor, then our 12-month average is 7292.96. So you see how that works out. So that concludes our presentation here, and I want to see if there's any questions from anyone before we break. Again, bank statements, most popular non-QM loan type. I mean, I've had cases on bank statement loans where the tax return income is like $3,000 a month, and the bank statement income is like $20,000 a month. So obviously, big difference there. I mean, it's 10% down instead of 5 or 3% down as you could have in a conventional loan, or 3.5% down as you could have in an FHA. But it allows a borrower to qualify for the loan amount that they need, and then they can make the decision if they want or they can afford the higher uh, down payment, and in most cases, the higher interest rate as well. All right, well, I don't see any questions, so I hope that means that I did an amazingly thorough job here for everybody. So I do look forward to seeing you in next week's training.